Hello guys and welcome to another video. In today's video I will basically talk about the banking industry and compare the 4 biggest US banks while analyzing their fundamentals, how these companies are doing with the virus situation, and as always at the end I will give you my personal opinion on them. Please, if you find a lot of value in my videos or you are just new to my channel, go and subscribe, smash the like button for the YouTube algorithm, follow me on my Instagram. First, I'm going to talk about the industry and how it's being affected, and then we'll go to my computer and analyze the fundamentals of the stocks. Banks are being affected in different ways. First, let me explain to you the exposure that they have to the energy industry. The crude oil prices have fallen near to $20 or even lower. Banks are lending industry that not only lend money to people or other businesses, but also lend money to oil companies or oil businesses. And if the oil industry does not go well, it's bad for banks, because if oil companies start to go to bankrupt, then they will stop paying those loans and the banks could end up having a big amount of unnecessary oil, since that's the collateral for those loans. For example, in this chart, you can see the breakdown of US bank exposure to energy industry. Citigroup had the largest exposure by outstanding loan balance of $19.4 billion on Q4 of 2019. Then comes Wells Fargo with $13.56 billion, Bank of America with $13.37 billion, and JP Morgan with $13.06 billion. Even though Goldman Sachs only have an outstanding exposure of $12.24 billion, that represents 11.2% of their total loan book, when other banks are between 1.4 and 2.8%. Now, it's not a secret that every industry is getting hit hard in different ways because of what is happening right now. Since what is happening right now has never happened before. This is not a financial crisis or a mortgage or housing bubble. This is just something that the entire economy is off because the entire country is in a shutdown. Well, actually, more the world is in a shutdown, but you get the point. And because of this, the Fed decided to help the financial system with the economic fallout. Last crisis, with the Great Recession, banks were the problem. And this time, they can actually have their moment, since they are better positioned as an industry to help the country and be able to grow the economy to where it used to be before the virus started. Now, why I'm saying this? Businesses will need loans to be able to sustain during these hard times, and the Fed is supporting banks by keeping the rates near to zero until the economy recovers, and also offering banks $500 billion increase in its holding of treasuries and $200 billion increase in its mortgage-backed security portfolio, so they can pump the economy by injecting money in it. Obviously, lowering rate means lower or less revenue for banks, but also means that the demand for loans and credit lines will increase like crazy. Because of what I said in the beginning, businesses will need financial help to not go bankrupt and get past the pandemic. And now, the 4 stocks that I'm going to analyze are the biggest US banks, which are JP Morgan, Bank of America, Citibank or Citigroup, and Wells Fargo. So let's go to my computer and do some calculation and analyze their fundamentals. Okay, so I wanted to start analyzing the stocks with you guys. How I normally do it, I have different ways to do it. It depends on the industry and a lot of things. But well, this is an example. So to start, these are the revenue charts for these 4 stocks. JP Morgan, you can see that's been in a constant growth since 2016 and exponential growth in revenue and earnings. Then Bank of America was the same until last year. That's dropped. We don't know why. I will have to look at it and see why that happened. Then Citibank, in my opinion, it's not the best one, but still, they haven't had like a big growth. It's been constant or stable, even though in 2017 they had a net loss. And then Wells Fargo was almost the same with stability, but it's been decreasing because I think from what happened in 2016, the scandal that they created falls. Okay, so JP Morgan has a market cap of $287.29 billion, Bank of America $204.59 billion, Citibank $92.87 billion, and Wells Fargo $123.83 billion. You can see that basically they are in a position from bigger to smaller, even though Citibank has a smaller market cap than Wells Fargo. Citibank has the biggest amount of assets in comparison with Wells Fargo. So they are in order according to their assets, not their market cap. JP Morgan at the moment has a PE ratio of 8.8, and their average 5-year average PE ratio is 12.79. So according to their PE ratio, you're getting this stock in a discount of 69%. Then according to the price discount, which is how from the beginning of the year, January 1st until today, it's being down 33%, and the lowest point between January until now was 44%. Then Bank of America has a PE ratio of 8.53, and the 5-year average PE is 14.09. So according to the PE, again, you're getting this stock for a discount of 61%. As a price discount from January 1st until now, the stock is down 34%, and the lowest point from January until now was 49% down. Then Citibank that has a PE ratio of 5.51, and the 5-year average PE is 11.48. So you are basically getting for a PE discount of 48%. The price right now is 46% down from January, and the lowest point was a 56%. And last but not least, Wells Fargo with a PE ratio of 7.48. So you can see that even Wells Fargo has a better PE than Citibank. But the 5-year average PE was 12.51, so you're getting it for a discount of 60%. And then a price discount of 47%, and the lowest point was 53%. Then their income statement, JP Morgan has had a revenue of $115.63 billion, Bank of America $91.24 billion, Citibank $74.28 billion, and Wells Fargo $82.57 billion. So again, you can see that Wells Fargo has the highest revenue than Citibank. For expenses, the highest one was JP Morgan, but it's okay because it's the biggest and largest bank. So normally, since it's being the biggest, it will also have more expenses. Then Bank of America with $65.25 billion, Citi with $54.889 billion, and Wells Fargo with $63.03 billion. Then their net final income, JP Morgan with $36.43 billion, Bank of America with almost $26 billion, Citibank with $19.40 billion, and Wells Fargo $19.55 billion. So even though Wells Fargo had a highest expenses than Citibank, it still have a higher net income. Then this operating expense ratio that I analyzed is, okay, so out of the revenue that they get, how much they use for their expenses, for dividends or taxes or losses that they have. So the best one at the moment is JP Morgan that only use 68% of the revenue for expenses. Then it's Bank of America, then Citibank, and then Wells Fargo. The highest the number, the worst. So you can see it as a percentage or in point. Then for the balance sheet, JP Morgan with an asset of $2.69 trillion, Bank of America $2.43 trillion, and here is where the difference comes. Citibank has an asset of $1.95 trillion, whilst Wells Fargo has an asset of $1.93 trillion. So there you can see that Citi is bigger in assets than Wells Fargo. Then the liabilities, JP Morgan with $2.43 trillion, Bank of America $2.17 trillion, and Citibank with $1.58 trillion. Last but not least, Wells Fargo with $1.74 trillion is the one with the highest liabilities between Wells Fargo and Citibank. Then this leaves us with an equity of $266 billion, $264 billion for Bank of America, $193.16 billion for Citibank, and $187.15 billion for Wells Fargo. So this debt to asset ratio is almost the same as it did with the revenue and expenses. So what it says is that out of that assets that they have, how much they have in liabilities. So for JP Morgan, they have 90% of their assets in liability, which in my opinion is high, but is different from other industries. Bank of America 89% or 0.89. Then Citibank 0.81 and Wells Fargo 0.90. But you can see here that the best one in the balance sheet is Citibank. Now for their free cash flow, JP Morgan had $6.46 billion, Bank of America $61.78 billion, Citibank had a negative $18.17 trillion, and then comes Wells Fargo with $6.73 billion. This common stock issued is how much in stocks that company issued last year. So this is 2019. No, JP Morgan, Bank of America, and Citi didn't issue any stock, but Wells Fargo issued $380 million in stock, which normally is not good, but then come the buybacks. The buybacks is when a company starts buying back, as the name says it, their stocks. So JP Morgan bought $28.76 billion in stocks. Then Bank of America, $30.71 billion in stock as well. And then Citibank with $19.55 billion. And then here comes Wells Fargo with $26.08 billion. So basically they issued $380 million in stocks, but they bought back $26.03 billion. Buybacks is good or bad depending on the stock. So for example, in my opinion, it's good when a stock buy their stocks back when the stock is very cheap. Normally when buybacks happens, the earnings per share increases as well if their net income stays the same as last year. So yeah, buybacks can be good or bad depending on when this company decided to buy their stocks. And last but not least, and what analysts are expecting for these stocks. So for JP Morgan, analysts are expecting a 4.30% increase in the revenue for this quarter 2020, which they will have earnings next week. Then for the end of this year, they are expecting JP Morgan to have a loss of 3.20% in their revenue. And then for quarter one earnings estimate, they're expecting them to have a 2.22 earnings per share for the quarter and 8.4 earnings per share for the year. Then with Bank of America, for the quarter one revenue estimate, they're expecting them a decrease of 1.70%. And then for the end of the year, they're expecting a decrease of 5.40%. For this quarter, they're expecting an earnings per share of 0.58 cents, and then for the end of the year, $2.2. Then for Citibank, they're expecting them to actually increase their revenue by 2.30% for this quarter, and then decrease for the whole year 1.80%. And then for this quarter one earnings estimate for Citibank, they're expecting 1.56 earnings per share and the whole year 5.79 earnings per share. Last but not least, Wells Fargo is the worst expected numbers from analysts, and that can be because of the cap again, since they can't grow more than what the Fed stated. So the quarter one revenue estimate is 10.40% less than last year quarter one. Then the current year, at the end of the whole year, they're expecting a decrease in revenue of 8.80%. And then for the quarter one earnings estimate, a 0.59 cents earnings per share. And for the whole year, 2.686 earnings per share. For the dividends, JP Morgan is offering a dividend yield of 3.82%, Bank of America 3.25%, Citibank 4.95%, and Wells Fargo with the highest one with 7.09%. So the payout ratio, in my opinion, the lowest the better, but it all depends, because in here JP Morgan has a payout ratio of 31.72%, then Bank of America 24%, Citibank with almost 24%, and Wells Fargo has the highest payout ratio, which is 47.41%, but again, they have a cap which it doesn't let them grow anymore, so this ratio is high, and can it be because of that? This is an industry that has revenue because of fees and interest, and nowadays people is going to other entities without any fees, and in my opinion, I think that bank industry will start changing little by little and eliminate these high fees or interest like they did already with transfers by creating sales. It's something like what happened with the trading platforms when Robinhood appeared with zero fees on anything. Then after a while, all other platforms were obligated to do it because people would prefer to start with a smaller entity like Robinhood without any fee than start with a bigger platform or entity like Fidelity or TD Ameritrade, but with a bunch of fees. But if you would like to know what I think about each stock, then JP Morgan, in my opinion, is a stock that has shown exponential growth over years. It's the biggest bank in the US, which gives them the best growth stability between the four of them. Then comes Bank of America, which has shown in the revenue chart was having the very good growth until last year, but still they have the best financial health between them, which means that they have the best debt and interest obligations. Citibank, in my opinion, has the best valuation according to the balance sheet since it's the one that has the lowest debt to asset ratio. And last but not least, Wells Fargo at the moment is one with the biggest risk because of the cap that the Fed imposed them but it's also the one with the highest growth exponential once that cap is eliminated. And it's also the one with the best dividend yield. So I only own Wells Fargo, even though all of the other stocks are good to hold or buy as well. I think that JP Morgan is not that undervalued in comparison with the others, but I prefer Wells Fargo because of the growth potential that they have, but it's a big risk. So I'm willing to take that risk. I don't know, guys, if you're willing to. So if you're not willing to, don't take it and go to a more secure stock. Again, I'm not a financial advisor, so I can't control your money. Please do your due diligence before investing in any stock or anything. Thank you for watching this video. That was all for today. Don't forget to subscribe, smash the like button for the YouTube algorithm. Stay home, stay safe. Follow me on my Instagram. Thank you and see you next time.